In recent years, the conversation surrounding investment strategies has evolved significantly, with a growing emphasis on environmental, social, and governance (ESG) criteria. Once relegated to niche markets or viewed as a moral obligation rather than a financial strategy, ESG investing has emerged as a formidable force in the financial landscape. It is no longer merely about doing good. It is about recognizing that ethical investments can yield substantial profits. This shift has been propelled by several factors, including changing consumer preferences, regulatory pressures, and a deeper understanding of the long-term benefits associated with sustainable practices. At the heart of the ESG investment narrative is the recognition that companies adhering to ethical standards often demonstrate superior performance. Research has increasingly shown a correlation between strong ESG practices and financial performance. Companies that prioritize sustainability and ethical governance tend to be better managed, face fewer regulatory risks, and are more resilient in the face of economic downturns. This is particularly relevant in a world where climate change poses existential threats to businesses and communities alike. Investors are beginning to realize that companies that do not adapt to these challenges may face significant financial repercussions. Consider the environmental aspect of ESG investing. Companies that proactively address their carbon footprints, manage waste responsibly, and invest in renewable energy sources are not only contributing to a healthier planet, but also positioning themselves for long-term profitability. The transition to a low-carbon economy is not just a moral imperative, it is an economic opportunity. As governments worldwide implement stricter environmental regulations, companies that have already embraced sustainable practices will find themselves ahead of the curve, avoiding potential fines and gaining a competitive edge in their industries. Furthermore, as consumer awareness of environmental issues grows, businesses that prioritize sustainability often enjoy enhanced brand loyalty and customer trust, translating into increased sales and market share. The social component of ESG investing also plays a crucial role in driving profitability. Companies that prioritize diversity, equity, and inclusion within their workforce tend to foster more innovative and productive environments. A diverse workforce brings together a range of perspectives and experiences, leading to better decision-making and problem-solving capabilities. Additionally, companies that treat their employees well, offering fair wages, benefits, and opportunities for advancement, tend to have lower turnover rates, reducing the costs associated with hiring and training new employees. In a labor market where talent is increasingly scarce, organizations that invest in their people are more likely to attract and retain top talent, thereby enhancing their competitive position. Governance, the final pillar of ESG, encompasses the practices and policies that guide a company's operations. Strong governance structures are essential for ensuring accountability and transparency, which are critical for building investor confidence. Companies with robust governance practices are less likely to engage in fraudulent activities or suffer from governance-related scandals, which can lead to significant financial losses. Investors are increasingly scrutinizing governance practices when making investment decisions, recognizing that companies with strong governance frameworks tend to outperform their peers. This trend is particularly evident in the wake of high-profile corporate scandals that have shaken investor confidence and underscored the importance of ethical leadership. The rise of ESG investing has also been fueled by the growing demand from millennials and Generation Z, who prioritize ethical considerations in their purchasing and investment decisions. These generations are more likely to support companies that align with their values, and they are using their economic power to drive change. This shift in consumer behavior is forcing companies to adopt more sustainable practices, as failure to do so could result in lost sales and diminished brand reputation. Investors who recognize this trend can capitalize on the opportunity by investing in companies that are not only ethical, but also positioned to thrive in a changing marketplace. Moreover, the financial industry itself is adapting to this shift. Asset managers and financial advisors are increasingly incorporating ESG factors into their investment strategies. recognizing that they can no longer ignore the implications of sustainability on financial performance. This has led to a proliferation of ESG-focused funds and investment products, making it easier for investors to align their portfolios with their values while still seeking competitive returns. The availability of ESG data and analytics has also improved, allowing investors to make informed decisions based on a company's sustainability performance. The financial performance of ESG investments has been supported by a growing body of evidence. Numerous studies have shown that companies with strong ESG ratings often outperform their peers in terms of stock performance and risk-adjusted returns. For instance, a study by MSCI found that companies with high ESG ratings outperform those with low ratings by an average of 3.3% annually over a 10-year period. Similarly, research from Morgan Stanley revealed that sustainable equity funds outperform traditional funds during market downturns, highlighting the resilience of ESG investments in volatile environments. Despite the compelling case for ESG investing, some skeptics remain. Critics argue that the focus on ethical considerations may lead to lower returns, as companies that prioritize sustainability may incur higher costs or forego short-term profits. However, this perspective often overlooks the long-term benefits associated with sustainable practices. While it is true that some ethical investments may require upfront costs, the potential for long-term gains, both financially and socially, far outweighs these initial investments. Moreover, as the market for sustainable products and services continues to grow, companies that embrace ESG principles will likely be better positioned to capture these emerging opportunities. Investors should also consider the risks associated with ignoring ESG factors. The consequences of environmental degradation, social inequality, and poor governance can have far-reaching implications for businesses. Companies that fail to address these issues may face reputational damage, regulatory penalties, and declining consumer trust, all of which can negatively impact their bottom line. By integrating ESG considerations into their investment strategies, investors can mitigate these risks and position themselves for long-term success. As the world faces unprecedented challenges, climate change, social unrest, and economic inequality, the importance of ethical investing cannot be overstated. ESG investing offers a pathway for investors to align their financial goals with their values, creating a more sustainable and equitable future. By supporting companies that prioritize environmental stewardship, social responsibility, and ethical governance, investors can contribute to positive change while also reaping the financial rewards associated with sustainable practices. In conclusion, the narrative around ESG investing has shifted dramatically in recent years, with a growing recognition that ethical investments can also be profitable. The convergence of consumer demand, regulatory pressures, and empirical evidence supporting the financial performance of ESG investments has created a compelling case for integrating these criteria into investment strategies. As investors increasingly seek to align their portfolios with their values, the future of investing appears to be not just about financial returns, but about fostering a more sustainable and equitable world. Investing in ESG is not merely a trend. It is a transformative approach that promises to redefine the landscape of finance and investment for generations to come. The time has come for investors to embrace this paradigm shift, recognizing that ethical investments are not just a moral choice, but a smart financial strategy.